Trade alert, get ready to short energy as Ukraine-Russia ceasefire is on the horizon. I believe we will see a ceasefire within 8 weeks. Exact timing is going to be difficult. The war and sanctions have backfired and they keep piling them on. I was ready to do a trade alert this week and Europe came in with an aggressive new sanctions package. This is the 6th package, supposedly sanctioning 2/3 of all Russian oil. I think the bigger kicker will be hitting their ships. And then by the end of the year, it's supposedly up to 90%. So that's why we've been hesitant to make a lot of moves. Our high risk portfolio remains in a 45% cash position, ready to pounce when the opportunity presents. The Russian ruble keeps going up. And essentially what we've seen is less exports from Russia, but higher profit margins. So far, this is not working. The politicians globally must end the war before winter. I believe they're pushing a big bluff to try to have more leeway when it comes to negotiations. Russia is currently on track to capture northern Donbass, and I believe that's when Putin will declare a victory and then start negotiating the release of wheat in exchange for a rollback in sanctions. And everybody will say they've won. And likely this we're going to see energy fall, bond yields fall into critical midterm elections. So we've got to be patient to enter the trade as again, Europe, USA continue to pressure the ceasefire by ramping up sanctions and sending more and more military aid. At this point, Ukraine really needs a lot of long distance weaponry to be able to survive the onslaught on Donbass currently. Now, we just took a 305% profit on Boyle. You give me Boyle back to 130, I will get you long KOLD, the way to short that product, but we're being patient for a good opportunity to enter that trade. Our top selling advisory is up 27% year to date for 2022. Not too shabby. A lot of people are down substantially. Depending on what you're in, you could be down 20, 30, 50. Some people have lost everything this year. Last year, very similar strategy, delivered a 233% return, turning every 10,000 into 33,000. Let's talk about how to get rich in 2022. And I think the same play will roll right into 2023. Basically, we want to do the exact opposite of how we made money most recently. So I'm betting we're going to see inflation rollover, fall, slow down in the global economy. And essentially, you're going to make the big money betting on lower bond yields. And as long as the war doesn't continue to escalate, that we should see growth assets like technology stocks finally get a bid after a 6-month bear market. So here's our portfolio for 10,000 bucks. You're only putting a portion of it to work today. So for $10,000, you're going to be able to put about $5,300 to work today. You're going to buy your crash insurance UVXY with 74 shares. You're going to buy your treasuries with 157 shares. And then you're going to buy your Ethereum ETHE ticker. So we're not going to Coinbase. We're going to our stock account, buying the Grayscale Trust and OTC stock with 185 shares. And that puppy is trading at about 30% below its book value. So assuming they can close that discount window, you could potentially get a little better return on Ethereum with ETHE than buying the real asset. Now, that has not proven true over the last 6 months, but at least it's insured in your stock brokerage account. You don't have to worry about getting hacked. So let's review this one by one, look at some charts per play. And then again, the big cash pile sitting there ready for, I think we may just likely see one more final spike in energy costs, and then we can go short. So we'll talk about that. Buy 74 shares of UVXY. With interest rates going up this quickly, there is risk of significant market volatility. Now, I'm not seeing a crash in the US consumer to the point where I think we're going to have a stock crash. Otherwise, we'd be getting out of stocks in our safe growth strategy. So at this point, the bond market crash has been remarkable, but markets have held up quite strong. So I'm relatively impressed with the value of the stock market, the NASDAQ, and Bitcoin, considering the just rapid rise in interest rates that we really haven't seen for decades of this extreme measure. Now, if we do get a big crash and we get big limit down days, that's where UVXY really shines. In the 2020 lockdowns, it did return 1,100% in a 4-week period. So a 10% position maintained over time can save your ass when we get a historic stock market crash. Not predicting that right now. And again, the consumer just continues to push retail sales to new highs month after month, while the lower income brackets are feeling the pain at the pump and with food. The wealthier part of the economy that does most of the spending is still pushing through nice and strong. So here's a look at UVXY this year. So it's been just violently going up and down, and we haven't really touched it. Step 2, buy 157 shares of treasuries. I believe the bottom's in on TMF, and we're likely going to push this to new highs over a 2-year stretch. That's the typical cycle for bonds: 2 years up, 2 years down, 2 years up, 2 years down. Well, you just had 2 years down, and the only thing I could see that would potentially crack the bond market even further would be spiking oil to the $150 to $200 level. You do that, you're likely going to crash the whole global economy, bonds first, and then stocks following second. And I just find that very unlikely, but that's why we continue to be hesitant until we do start to see progress with the ceasefire. And unfortunately, so far they're still playing a big game of chicken. Here's a look at the TLT. This is the level I was predicting we should be buying bonds and that we would have maximum interest rates. The part I got wrong was the time frame to reach there. So we were telling investors likely we'd hit that 2023 or 24, and it'd be a slow grind down. But instead, the bond market went straight there in a few months flat due to inflation being far worse than anyone had predicted. And now we have Janet Yellen coming on TV saying, my bad, miscalculated the inflation. Now the 2-year bond is telling us what the federal funds rate's going to end up at. And what's critical is it's stopped going up. It's trading flat. So this is telling us the Fed is likely going to stop raising interest rates around the 2.5% range, maybe 2.75. So we're at 0.75. We're basically predicting they'll most likely raise 50 basis points June 15th, another 50 basis points July 27th, I believe is the date. And then they're likely going to start slowing down, maybe one more 50 basis point rate hike, maybe slow down to 25 basis point. Let's keep a close eye on that 2-year. As long as that's trading flat and starting to slide, means we are essentially past the peak tightness in the bond market and can expect what the Fed will do ahead of time. Now, here's a look at a bunch of different bond markets, and all of them are falling. So if we're long cryptocurrencies or the NASDAQ or emerging markets for that matter, this is really good news. None of those markets like interest rates to rise. And when we look at the $30 trillion of debt we have publicly, we've got another 30 trillion privately. If we look at all the promises US government's made, it's another $100 trillion of unfunded liabilities. It means the US government needs to borrow trillions of dollars indefinitely. And so the interest rates are highly motivated to not go any higher. Otherwise, government can't make good on all its promises. So I'm quite confident that there's probably a 90% chance, if not higher, that the peak interest rates have been reached. We're probably going to trade sideways until energy costs come down. And then you're going to see those interest rates fall viciously. So bonds and tech stocks are where you make the big money over the next 12 to 24 months. And I really see a shorter window of up to 12 weeks where we could see one more one more problem for bonds and for energy costs to go up even higher if things get out of hand in the conflict in Europe. Now, the Fed has a 100% track record of getting energy costs down through monetary tightening. In this chart, we're looking at the commodities price index in the black. The red's the rate of change, and what's important is the blue lines. That's where they've tightened. And look what happens to the red line and the black line eventually as they tighten. Without exception, the rate of change goes negative and the energy cost goes down, and because this slows down the economy. So it could take a little while. It can certainly take a little while, but most likely energy costs have topped out. I see a risk of them going higher, and our main catalyst to aggressively short energy will be the ceasefire, and which again would lead towards a reversal in sanctions. This is a rate of change of interest rates, just to give you a feel for how unlikely this was. We've essentially never seen interest rates rise this quickly in such a short period of time. So this caught everybody off guard and did devastating moves to the bond market. I believe this is now over, and that's why we've been carefully beginning to build a treasury position. Now, if we believe interest rates could go higher, and it'd be due to more sanctions on Russia, disruptions of supply chains from China, inflation just getting way out of control, there certainly could be more pain ahead. But at the end of the day, this is going to collapse the economy and drive these rates lower. So I don't mind having the risk of volatility or drawdown in my treasury position, knowing that a good scenario, end of the war, rates go lower. A bad scenario, inflation spirals out of control, supply chains remain broken, companies can't deliver goods and services. At the end of the day, either way, these bond yields will go lower over time. Here's a look at the duration of the bond crash, 2 years, and again, the biggest decline in history. So this is very unusual. Buy the dip. If you're looking for blood in the streets, there you go. This chart's looking at the bullwhip effect. Too much demand, too short of a time. So retailers built massive inventories, and now the sales are slowing down. So look for big discounts to clear out all this inventory coming in the next few months. In this chart, we're looking at PMIs of Germany, China, Japan, Taiwan, all crashing below 50 into negative territory. Quite likely US will follow into their footsteps. So essentially, we're expecting the Fed to do 2 more aggressive rate hikes to catch up to the 2-year. Bond market won't care whatsoever because it's already moved up that high. And then they're likely going to slow down or stop rate hikes as soon as they have material proof that inflation is indeed slowing down. Another look just comparing China's PMI to the US, same picture. And again, China's now reopening. We'll see that PMI come back up a little bit, but this is typically a 6-month delay, and what happens to China is going to affect the US. And that's exactly what this chart is, a 6-month gap between the Chinese PMI and the US. This chart was the most recent heat map of inflation, and you want to be worried about anything that's red. Anything that blue is actually going into deflation, and essentially everything is dramatically slowing down except for energy and transportation, which of course relies on energy. So we know what the catalyst will be to get that energy cost down. It's going to be a ceasefire. The whole global economy is going to get crushed if they don't resolve this war, and it's highly likely going to occur in the next 3 months or less, maybe much sooner. Step 3, buy your ETHE. So this is down just massively, much more than the actual assets down. And so we do recommend building into this position right now, as we believe the energy costs are most likely topped out, bond yields are mostly topped out, and we've seen extraordinary support for Bitcoin. Given what's happened, I'm surprised Bitcoin's not at 10,000. So a lot of people are worried it could go to 20 from here. Certainly possible. What I tell investors is if it were going to go to that level, it would have already happened. Everything that possibly could have gone wrong has gone wrong in a short time period that almost no one predicted. And this asset remains remarkably strong. Bitcoin today still at 30,000 bucks. Now here's the actual Ethereum asset uh, hovering at 1844. It got up to 1950 this week, 2000 pretty good. Line in the sand, just a mental line many investors look at. If it goes above that, a buying frenzy gets involved. If it goes below that, everybody's freaked out. We're headed to 1,000. We've got massive shorts in Bitcoin futures. We've got massive short positions in the NASDAQ. So I'm telling you what's going to happen. The second energy goes down, bond yields fall. These folks are going to get short squeezed and they're going to have to cover by buying that asset. So a melt up is not far away. This chart's comparing the S&P 500 to the NASDAQ. And so the S&P 500 is more weighted in value, while the NASDAQ's more weighted in growth. And it shows you when the value is outperforming the growth, the trend line has been hit for a reversal. So that's exactly what we're expecting here, is growth to outperform. And again, with the high risk strategy, we're big on Ethereum. And this is just looking at Bitcoin's return, which are of course very correlated to Ethereum's, just smaller. Extraordinary returns. They've been getting smaller every year as the market cap has grown, but just the fastest growing asset in history, fastest user growth, and the writing's on the wall. We now have Russia talking about taking payments in crypto. We've got JP Morgan saying it's their new alternative asset after Jamie Dimon bashed it for the last 5 years. We've got Ray Dalio getting in on it. We've got country after country getting in on it. So it's the new alternative currency, and there's really no turning back now. This chart says, don't look at the highs, look at the yearly lows. We've only seen a new low year over year in 2015. That's when China's housing market nearly crashed and we were about to enter a tightening cycle in the US. And then what happened? China ended up printing trillions of dollars as the US did rate hikes and eventually quantitative tightening, and you ended up with Bitcoin ballooning, get this, from $190 at the bottom of 2015 to $20,000 before it crashed in 2019. So just a wild, wild sequence of events there. It really pays to hold this asset long term. Also, just statistically, it's been unusual for Bitcoin to pull back for more than 7 weeks in a row. And so we pulled off 8 weeks is the bottom in. Volume spikes also have signaled bottoms in for Bitcoin. So we're cautiously optimistic that we could be at a bottom. What's causing the volatility today? The energy spike due to Europe certainly caused another sell-off in bonds, not to new lows, but that was one problem. This seems to be the other big problem. And we've been warning our investors to stay the hell away from Celsius. Celsius was a phone app that would allow you to deposit your precious Bitcoin in exchange for an interest payment. And I warned you, you don't know what they're actually doing with your Bitcoin. If you don't hold the key, it's not your Bitcoin. And sure enough, looks like they've had a bank run on Celsius. Users are now waking up to find they're not allowed to pull out their funds. There's some bullshit sign saying that your account's been converted to a holder account, contact support if you want to get your money out. And that's most likely because they don't have enough money for everyone to get out. So we had Terra Luna blow up. We had the bond market blow up. We've had the threat of regulation from this administration, on and on and on. And Bitcoin still trading at 30,000 bucks. What else is going to fuel the growth of cryptocurrencies? In general, it's when governments spend more money than they make. That's why you want to be long cryptocurrencies. And we now have Japan doing what's called yield curve control, printing like crazy to protect their bond market. Now, if the US bond market keeps going lower, they'll have to do yield curve control as well. Otherwise, the government's insolvent. Now, I don't think they're going to have to do that, but Japan already is, and we can see their currency has devalued by 10% against the dollar while they're doing this. This has been making the relative value of the dollar look stronger over the last several months. China is now printing trillions due to the real estate mess. That's how they keep their GDP targets above 5% a year. They build stuff that nobody needs, and they've been doing this for decades, and they have no intention to stop. Otherwise, China goes into a Great Depression and takes everybody with it. And so here we can see their yuan now going into a devaluation mode as well. The dollar will fall as the Fed soften hikes, and the 2-year is starting to tell you that's coming soon. If the 2-year was still going up, then we wouldn't be believing that was the case. The last thing that has to happen is food and energy inflation needs to fall. And again, we know what's holding that back. Here's a look at DXY. If you're a Bitcoin boy and you made a lot of money from 2008 to current, get this, you did it with the dollar going from a level of 70 to today, a new high of 103. It's a little bit lower than that today at 102.5. This is going to cause lots of problems at this level. Namely, it makes it very unattractive for foreigners to buy our debt or to pay their interest payments when the dollar's appreciating against their currency. And furthermore, has the risk of reversing. So imagine the profits you're going to make with DXY falling. The last time we had a major melt up in crypto, we went from 100 to 90 on the DXY. And that's quite likely what's going to occur over the next several years, as soon as these energy costs start to subside. Okay, so step 4 is wait to short boil with ticker KOLD. Can make sure you have it. Natural gas at $8 is ridiculous. It's usually at 2. I don't think we're ever going back to 2, but we could certainly see it fall to probably the $4 to $6 range with a ceasefire. And that's going to be critical for Europeans to be able to afford their electricity bills as we head into winter. So definitely there'll be massive motivation to reverse sanctions and release natural gas and food very soon. Otherwise, politicians globally are going to get strung out by their voter base. Here's a look at Boyle. This is a little older. We're trading at 115. If we get back to 130, I'll be ready to invest in KOLD and bet that this is not sustainable. So we're being a little patient here. Oil back to 130, I'd be willing to short oil. I think that we'll see everybody try to push it down at that level. So what's Russia up to? I believe they will be happy to take Donbass and then regroup. It looks like their plans are to essentially build a bigger border and take over more countries than just Ukraine. So it looks like NATO wants to punish them as much as possible before doing a ceasefire, and that this is just part of a much longer battle. That's a war that's going to play out, probably lasting years, maybe over a decade. So Cold War 2.0. So we'll have to be very mindful of that the coming years ahead. Second conflict ends, and again, we believe this will just be a short pause in a longer battle. We want to go along the tech stock FNGU, especially if China is going to reopen, which it looks like they are. So FNGU has been clobbered from 50 down to 10. We've seen it go as low as 7. So it's up 40% in the last 5 days. And again, I'm just being a little more patient to buy that. We have some interesting things coming up. We've got the CPI next Friday. I'd like to see that fall, and then perhaps see what's happening in the war. And we're going to potentially get us into FNGU instead of adding to treasuries. But again, the immediate trade will be to short energy and then take those profits and go long tech. And my favorite play is FNGU. It has the best US tech companies that get massive call option activity. And it has 2 Chinese giants that we're bullish on, which are Baidu and Alibaba. And again, just remind you, last time US was tightening while China was printing because of their real estate market crashing. Bitcoin went up 4,400%. And what happens next on this chart is Bitcoin crashes, but that's because the bond market was going to go up for a year. So unless we think the bond market, by that I mean the yields were going to go up for another year, and ended up crashing Bitcoin, then emerging markets, then Europe, and then finally the NASDAQ when the 10-year hit 3.5% in October. So we don't believe that's the case. We believe the end of the bond route is essentially over. Now, if again energy goes skyrocketing much higher than it is, we can change that opinion very quickly. So that's why it's important to watch the webinar every Monday, Wednesday, Friday, and be ready for sell alerts. If you're catching this video on YouTube, call Dean now at 505-322-7515 because you won't get the trade alerts. You're just getting the old content. Okay, I've got some really good Twitter feed content today. And I'll take a quick look at the chats. Okay, so we got a lot of content in the Twitter feed. Solana's networks halted. I'm glad in our Rebel we consolidated only to Ethereum. Two of their competitors have essentially blown out. Solana's had to reboot and halt their network multiple times now, and Terra Luna went to zero due to an attack on their stablecoin. So we're playing with the key operating system of the future, Ethereum, as our main investment for our high-risk tech growth position. German government source, so Germany's going to send more long-distance rocket systems to Ukraine. Valina, who I like to follow, she's very pro-war, pro-NATO. So as you know, it's not my personal opinion, but I respect what she has to say. Do you think that let me make this a little bit bigger. Do you think that Russia has coincidentally decided to block the biggest global choke point for wheat, the Black Sea ports, for food exports? Of course not. It was all part of the plan, given the leverage Moscow was having in advance in pressuring the West on lifting sanctions. Russian oil producers using Indian refineries to hide origins of refined products. So all this oil still getting out, just much more sneaky and with more brokers driving up the price. David Hunter says he thinks oil could fall to 30. John Malden says you must be smoking some really good stuff. I think 130 is more likely than 30. Where does that supply come from? So I think that's where we may potentially top out at 130, which is where I'd get short, and that there's just a risk of that. It's probably not going to happen. But yeah, as far as my target for the low side, probably more like 80 to 90 in a vicious sell-off, because I do see a super cycle in commodities ahead. We're just looking for a reversal of this play in the short term here. Valina says, my scenarios for the Russia war on Ukraine: heavy weapons for Ukraine, plus economic sanctions triggers a Russian implosion. 2, failure of the above leads to a victory for Russia in Donbass, and the war goes on. Except she thinks that Putin will declare a ceasefire, demand reversal of sanctions, rebuild, regroup, and then continue his expansion. And then 3, heavy weapons plus no international isolation, bypassing sanctions leads to a bigger frozen conflict. It seems like this is the scenario we're heading through right now. The sanctions don't seem to be actually working. China's PMI is starting to go back up as they turn back online. We're now in the QT schedule, so we're starting to sell $95 billion worth of mortgages per month. And we have two rate hikes coming in. So that's some good reason to be a little patient with the markets here. John W. Rich, just a funny Twitter account, says, "Forget Bitcoin, oil's going to 100,000 first." JP Morgan says it's premature to call the bottom in stocks, which appears to be a consensus view given QT is about to launch. We're going to get another 100 basis point rate hikes over the next 8 weeks. 18 months ago, Zoom had a bigger market cap than Exxon. Today, Exxon's 10 times bigger than Zoom. So again, we're looking for a reversal of a trend that's been overdone. Shanghai lifted the 2-month lockdown on June 1st, and the city's subway system has recorded 900,000 passengers, about 50% from a year ago. So slowly but surely getting back to normal in China. $700 million in new lethal aid to Ukraine. Just keep the money flowing. Okay, this is Gemini of the West. I believe he's pro-Ukraine, but a fair analysis, I believe. Overall assessment, the longer the war goes on, the more of a wicked problem it becomes, something Russia may be counting on to ensure it can meet some of its goals. A long war tests the West's true commitment to Ukraine's defense and ability to reclaim its territory. Ukraine is better positioned to meet its war aims with continued support, military, financially, and most importantly, morally. Although Ukraine has its own resourcing issues, it is being a better steward of its military capabilities. Western support will lead to victory. However, if the Kremlin proves savvy enough and exploits current Western diplomatic disagreements, namely that's Germany and France that don't want to go so gung-ho on these sanctions, they can severely impact the flow and timelines of aid to the point that a few delayed shipments of critical armaments may tip the scale at a perilous moment. The first 90 days of this war has seen excellent Ukrainian generalship and the fighting audacity of the Ukrainian armed forces. Russia, however, can still turn things around to its favor if it's more strategically prudent and operationally savvy. The West must stay the course. And the tides do seem to be turning in Russia's favor at this point, but Europe and America are certainly amping the ante on at least rhetoric, talk for sanctions, and sending more money and military. So too early to call. From our point of view, we just want the war to have a ceasefire. Whoever wins, we don't really care. Jury and Timmer, just like that, the stock market seems to have found its footing a few weeks after bond yields put in a trading high. After a relentless rise, the cost of capital is now moderating across the board, from mortgage rates to corporate yields to S&P 500 earning yields. The Netherlands just joined Finland, Bulgaria, and Poland on Russia's do not sell list. Russia indicating Denmark is next. We are well on the way to Russia's only customer being Germany and Turkey. That's when European splits will be laid fully bare. And that's people refusing to use the ruble for payment. Agreement was reached to ban the export of Russian oil to the EU that immediately covers more than 2/3 of oil imports from Russia. The sanction package also includes de-swifting Cyberbank, banning 3 more state-owned broadcasters, and individual sanctions. India is still picking up oil and fertilizer from Russia. This little piece showing a lot of the weapons going to Ukraine are ending up in the Middle East, being resold. Here's a big thread that's just really highlighting the attack in Donbass that's been slow but steady. We may be weeks away from this being achieved. So if you want to get really detailed, you can follow my Twitter feed. I'm going to go ahead and skip through that. But yeah, there's a lot of great analysis out there on what's happening in the war if you really want to get to that detailed level. Yeah, we have a P&L chart. I'll look at that. I mean, we can pull that up right now. So yeah, the safe growth strategy depends on where you started from. So we had 25% return year to date 2021, and we're down 12.5% 2022. The high risk portfolio is at a 233% return for 2021 and a 26% return for 2022. Now, unfortunately, a lot of people jumped in right at the very peak return uh, and have probably hit the very top of our return and the biggest drawdown period. Um, but yeah, considering everything, we are greatly outperforming the S&P 500 with leveraged assets in the safe growth portfolio, and we're certainly outperforming everything with the high risk portfolio. And so some people don't necessarily follow the complete trading plan, or they may be started at the peak return and then jumped right into a drawdown. There's one more big thread I wanted to read for us, and then we can go into charts. For Ukraine, the choice remains between a war and complete subjugation in the long run. For Russia, however, the choices were between short war, it failed in the first phase of the war, and a long war, the current scenario, while the West presents the choices between war and peace. And we're about to get a big thread from her. That was really good. And we can move into charts. We have a question saying, why would gas go? So yeah, normally gas is $2. Right now it's at 8. And so that rapid increase was due to the conflict. So essentially we're betting that if the conflict is reversed, the cost of gas will go down. Joe's saying, would I buy gold or silver? No, I still think we have very robust economy. with 10 million, twice the jobs relative to uh, the opening. So no, I don't see any reason to go along that. All right, guys, I'll pull that up for the next webinar. Essentially, she believes that if Russia takes Donbass, Putin will declare a victory and then negotiate a reversal of sanctions to release food. And I think that's the most likely outcome that's on the horizon. But that the catch is that this will be a much longer, drawn out war, and he has much greater ambitions and more territories to take over time. The alternative is Russia gets pounded to the ground and gives up. And if that were the case, I believe this would escalate much more aggressively because it would mean the end of Putin. And so yeah, that's really the two outcomes we're looking at here. Okay, here's your 40 years of bond interest rates falling over time. This trend is unlikely to change, and I believe we are at peak interest rates, which means we're very close to peak energy costs, and should get ready to play the exact opposite that made us money, betting on oil and oil going up. This is the probabilities for rate hikes, as long as it's just a 50 basis point rate hike from 75 to 125. The bond market should be very happy. That's currently what's priced into the bond market. We have $1.9 trillion sitting at the Fed that could be injected into the economy. So that's another source of liquidity that's not yet been released into the markets. We look at the gold to copper ratio called Dr. Copper to predict interest rates. Copper is below gold. This is predicting lower interest rates ahead. Here's a look at what's the Achilles heel to the global economy, and it's these expensive energy costs. This has driven oil and energy use sky high this year, and it relentlessly keeps going higher. Depending on where you go from, you could have made up to a 368% return in NRGU. So, as you know, we sold NRGU for a big profit, and then we sold oil for a big profit. And now the risk reward ratio is not in our favor. While I do see the risk of these going a good bit higher, which would mean the war was getting aggressively worse, I think the most likely outcome is the top is near and a severe pullback is ahead, and that growth and bonds will get the bid. Lumber futures are painting the same picture. So we can see lumber futures predicted a sell-off in oil 2 months in advance last June, and they've been doing it since March. So oil's been trading sideways since March. And I believe, again, that we're going to see oil pull back. Now, I'm not predicting $40 oil, but perhaps to the $80 to $90 range. I'd be back long in RGU. This is the dollar index. We've been fighting a strong dollar for a good year and almost a half. This is very bad for cryptocurrencies and growth stocks and emerging markets. So unless we think the dollar is going to 120, most likely it's going to turn over and fall from here. Now, if we zoom out a bit, we can see it has gone to that level, and it led to the dot-com crisis. These are the main countries printing money right now aggressively. China and Japan, we can see their currencies have been devaluing against the dollar, but starting to roll over, which means the dollar could start to roll over here. This chart's looking at Polygon, Ethereum, and Bitcoin, just showing you the relative volatility in our three favorite growth assets. Now, Rebel Dividends is actually going to expand into about 5 other software applications designed on Ethereum over the next few weeks, because there's just big sell-offs in a lot of fast-growing applications. And it reminds me of Amazon in the dot-com bubble, losing 98% of its value, even though it had growing user growth and revenue the whole time period. And if you had bought and held through that, you did extremely well several decades later. This chart is potentially the most worrisome. We have interest rates rising, and we have oil going up with NRGU. we'd expect the candlestick NASDAQ to go down, but we would not expect the banks to be getting so beat up. So this is perhaps the most eerie chart we have because the banks have lost their relationship to going up with interest rates rising. This chart, we're looking at emerging markets against the S&P 500, trying to spot the turn in the tide when emerging markets may outperform the S&P 500. Most likely, we're going to need bond yields falling and the dollar falling, along with energy costs. So that's when I might get more aggressive with, again, FNGU for the high risk or EDC for the safe growth portfolio. Zooming in on emerging markets, we're looking at Alibaba, Tencent, and Taiwan Semiconductors, and looking for some big jumps in price, especially Alibaba, Tencent outperforming Taiwan Semiconductors to show that China is done regulating their tech sector and are going to be pro-growth for these important companies. So far, not happening. Here's the European index we hold in the safe growth portfolio. Below the 2020 high, but above the March crash low. And this is with the war impacting all sorts of supply chains in Europe. So we're going to expect they're going to have to be aggressive with spending to fix all the problems this war has created. And we remain long with the smallest position in the portfolio with EFO. This chart, we're looking at some alternative metals for clean energy. So we got rare earth metals and we got copper miners and uranium. Right now we're long RMX and uranium in the safe growth strategy. And there's quite likely a massive shortage of these supplies in the coming years if electric vehicles stay on target, which it does seem to be the trend, as well as just the use of iPhones using lithium and cobalt. So we remain long REMX long term, as well as uranium. And all sorts of questions about not following the trading plan. That's essentially how you'd end up with different returns than what I just showed you. So I would not recommend not following the trading plan. So just buy the units and be patient. This chart, we're looking at the TLT, silver and gold, seeing if anything is doing well against the crashing bond market. The answer is no, just about nothing's going up as long as bonds are crashing. As you can see, the TLT has flatlined since May 8th and has been getting some support here. So I think as long as the bond crash is over, a little patience will go a long way with very few changes to the portfolio. This is the key inflation data that did fall in April, and I believe it will fall again in May. This is not including food and energy, so that's important. So once again, we get this new print, not this Friday, but next Friday, and I do think it will continue to fall and be good for the bond market. Payrolls continue to come in at a relatively healthy clip. We have twice as many job openings as there are jobs, and the wealth effect in a lot of assets, the poorer part of the population were invested in have been wiped out, like cryptocurrencies or the lockdown stocks. So people are having to go back to work. I expect the labor markets to continue to grow. Now we are seeing some hiring freezes in tech companies, but it does look like they just went overboard on hiring. So in general, still see a robust economy with no recession in the near future. Bank credit continues to grow at a rapid pace, no freeze in bank credit, and credit card draws continue to grow. This is driving the U.S. retail sales higher and higher. They're slowing down, but they're still growing. And you can see we just hit a new record consumer spending. So it looks like the money's moving in the economy, not just falling off a cliff. Bet on a weak dollar long term. We really want to see growing trade balance negative, which we have, and continued growing of debt, both of which are occurring. Big news was a big drop in the housing market sales, but still relatively a large amount of housing sales. If we look at the overall trend, uh, most likely this will bottom out and go back up as interest rates begin to fall. So we might see some price pressures coming down, but I'm not seeing enough data to get worried about a high housing crisis right at this moment. We'll keep close eye on this data over the next few months, and we should see it bottom out and come back up with interest rates falling. China's PMI went really negative with a lockdown of half the country, but now that's reopening, caused their imports and exports to fall, but these are rising. Big picture, these are still at very extreme levels. So while China slowed down, it's getting back on track right now. Here's a look at the Federal Reserve's balance sheet. And again, 2016 to 2018, they were doing rate hikes. 2018 to 19, they were trying to do quantitative tightening. And the bond market was crashing from 2018 onward. And that's what crashed global economies. So unless we believe the bond market's going to crash from here, we really don't want to change positioning. Stay course, be patient. Here we have the European central banks still printing away. Okay, so let's go ahead and go to the position calculator. We've told you in all the updates, keep oil in cash. So safe growth has 18% or 19% in cash, and that's going to be used to short natural gas or oil at the right time. Maybe a little more patient. That's the only play I see coming in the near term. For the high risk portfolio, you have a even larger position, about 45% in cash. We may not put all of that into shorting energy, but we'll put a lot of it to work. That's the next big trade to make a lot of money. We just need to be a little more patient here. And again, let's look at the track records. So, we've got all sorts of claims about drawdowns. If you had bought at the very peak in November and went all in, you could be having a potential maximum drawdown, if you were following the program at least, of negative 27%. Okay, if you're not following the program, you may have a different result. And a lot of people do that, I'm afraid. But that's really the maximum drawdown you could find in the safe growth portfolio over any period of time. So if you have a bigger drawdown than that, you're not following the program. The high risk portfolio, let's see, what's the biggest drawdown I can find you? The biggest drawdown we could possibly find would probably be, I guess, just from May to June. So the maximum drawdown anybody should have in high risk is negative 8%. So if you're not following the product, maybe you should. Not to scold anybody out there. All right, guys. We'll take any questions and wrap up today's show. Sean says, why not buy more TMF? If I had to buy anything, Sean, I would be buying TMF. My personal portfolio's all in on crypto and treasuries after having sold all my energy, just like you guys. I mean, that's really what we have. And I got a big cash position. I'm basically following the high risk personally. So yeah, I want to short energy. I want to keep some cash on the table. I'm not sure what the hell is going to happen in the war. If oil goes to 150 and natural gas goes to 10, and the Fed wants to sit there and dump 100 billion bonds and keep jacking up interest rates and the inflation comes in too hot, we could see another leg down in bonds. So I'm not completely convinced 100% that the bond market crash is over. I say about 90% is my conviction on that. Yao says, we missed a 50% jump in F&G. I know. So yeah, I mean, I wish we'd bought Boyle at 70 when we had that pullback, knowing the war was nowhere near over. So we missed that. We missed the jump in F&GU. We're being a little bit of a wimpy wimpy poker player here, just kind of folding a bunch of hands till we've got the royal flush kind of way we're looking at, because this market's been very difficult to predict. So yeah, I basically want to get, what's causing all this ruckus. It's the darn war. So as soon as we have a better, clear picture of the war, then we can do that. Well, yeah, we did, Sean. So we did one purchase, and we've been waiting. So the the key here is to look at the timeline. Yeah. So Yao says, are you still preparing to buy F and G? If the war ends, I want to short energy and then rotate into F and G. If the war is not going to end, I want to wait for energy to spike to an outrageous level, still short it, and then buy treasuries. I'm not so fond of betting that energy is going to spike higher from here, because while it might go up another 30, 50%, it could also crash 50 to 70% on these leverage products. So I don't like the risk reward of energy at this level, because the downside's like 3 to 4 times the upside. Um, but we got a huge cash, guys. We have a huge cash position in both portfolios. Yeah, basically what I'm hoping is going to happen is we're going to see Boyle hit 130 and we're going to short it. And then we're going to take profit and buy either treasuries if it's a bad scenario or FNGU if it's a good scenario. Now, if energy just falls and I miss shorting it, we'll just simply go either buy treasuries, again, if it's a bad scenario, which unlikely. Most likely by the time energy's falling, it'll make a lot of sense to go into tech and more aggressive in crypto. Same plan. Yeah, KOLD. Make sure you have that. Now, if you don't have KOLD, buying FNGU is essentially very similar play. That betting, if energy is going to go down, tech's going to go up. That's really the relationship we're predicting is going to occur. Now, there are some instances where energy and tech fall together. And that's typically when this bankruptcy is occurring and the consumer gets completely wrung out. We're just not seeing a weak consumer to believe we have a collapse in the stock market. So we got Boyle to 115. You give me Boyle 130, I will give you at least a 10% position in KOLD. Yeah, it's a leveraged product. So looking at charts on these leveraged futures products are very misleading. But yeah, Boyle and KOLD are inverse relationship. So if you look at Boyle long term, I mean, it was at 1,000, went down to some absurdly low number when we bought it, and now it's gone up to 120. KOLD. Yeah, we don't have it in either program yet. But look, we got Boyle at 117 today, so just push it up to 130, and I'll be confident to give you a 10%. I can guarantee if we get 130 on Boyle, I will put 10% in both portfolios into KOLD. Maybe more in the high risk. We might And that would still leave a little cash so that we could wait another week or two, see if it, who knows if natural gas goes to 10, 12, 14 bucks, and then oil would go up to something like 2 to 300. So it's just a really dangerous play. Um, it's extremely unlikely natural gas could stay at that level. People would not be able to afford it, frankly. So yeah, the problem with the market are the energy costs. This is driving inflation to remain sticky. So that's really the only thing to worry about in the markets right now. Mary says, "Why are you expecting oil to not go higher when it was over?" Yeah, so these prices in the past are not like a stock, so it's really very misleading. Here's what you guys should do: rather than look at boil, I'll show you what you guys should look at, so you have a better way to look at this. So if you're in trade view, and then I will hide. I'll start including this so you guys can see what we're actually trading. Yeah, so it's a futures product, and it has to do with backward. It's a very complex thing, but um, here you go. So for all of history, natural gas has been pretty cheap until this war broke out. So the normal range for natural gas, and we'll have to find one that goes back further, has been about $2 to $3. And then this war breaks out, and Russia starts playing with the supplies, trying to get everybody's inventories lower. And they've driven it to $8, as high as 9. So it's absolutely ludicrous. The reality is this will probably fall back to the $3 to $5 range long term. No, no, no. So Boyle is playing futures contracts, trading natural gas. So the change of price of natural gas will affect whether Boyle goes up or down. So I expect as the war ends that the price of natural gas will do something more like the lumber futures. It won't go back to the old historic prices. I believe we're at permanently higher prices due to something like 15, 18 trillion dollars being printed globally. So the cost of everything is just going to be permanently elevated. But I believe that it will go back down. And I think we'll see it trade in the $3 to $5 range long term. And that only when the war's picking up that we'll get to these $8 to $10 ranges. And $10 is stretching it. The electric bill in Europe has gone up 4 times. So it's just not politically possible to keep this going for very long. Because that's how they create the electricity. 25% of electricity is through natural gas. And now, of course, they're going to start firing up coal plants. And of course, Germany's been shutting down their nuclear plants. It's just absurd. But it looks like about 24 months to be able to replace the Russian gas supplies through Qatar and America. There's just no quick solution here. Yeah, so KOLD will be the way to bet on natural gas going down as soon as the war has a ceasefire. So I have let me try to find the YouTube channel. if you want to get a good daily video on what's going on in the war, Military Summary is the YouTube channel. And I don't feel like he is he's probably pro Ukraine, to be honest. Um, this fellow does a daily video, very detailed, uh, in my opinion, relatively unbiased, detailing what's happening in the war. He's not trying to make political predictions, but if you want something daily, so if I see Donbass is really essentially going to fall, I'm going to predict that quite likely Putin's going to take a break because he's lost a lot. He has lost a lot. He needs some sort of victory, and he needs to most likely regroup, and Western civilization needs to get inflation down. Otherwise, their bond markets are going to crash further. So that's really what I'm watching right now, is watch for Donbass to fall. Now, if it fails to be taken, then Russia's probably going to get desperate. And that might actually make me potentially be worried that we would see another big spike in energy and another big drawdown in bonds. Because yeah, Putin, it's not politically possible for him to walk away from the war at this point without some sort of victory. All right, guys, we'll be back on Friday. But yeah, if you want to follow Military Summary, that's a good one. And yeah, this is really what's going to shape the markets in the short term. So yeah, these energy costs. All right, beautiful. Well, thank you guys so much. We will be back on Friday, and we'll give you an update on what's going on here. Everything is happening quite quickly in that region, so a lot of action on a daily basis. This video is about 20 minutes long. All right, guys, thank you so much. We'll see you back on Friday.